Item on our agenda is the keynote address, and who better person to deliver that than our very own Prashant Jain of the HDFC Mutual Fund, ED. Before I introduce Prashant Jain, who needs no introduction to this audience, I request VK Sudarshan, General Secretary, to please honor him with a shawl. A brief and a quick introduction on Prashant Jain. Prashant Jain is the Executive Director and Chief Investment Officer at HDFC Mutual Fund, India's largest mutual fund with assets under management of nearly US dollars 25 billion, of which 10 billion is in equities. Prashant is also manager of 3 equity schemes with assets of US dollar 6 billion. He has a distinction of having managed a fund continuously for over 20 years with a CAGR of 20% plus approximately. Prashant is basically an IIM, IIT Kharagpur and IIM Bangalore product, and he has spent over 25 years now. He is on his 25th year in the mutual fund industry. Gentlemen, please give him a big round of applause to welcome him to give us a perspective. Over to you, Mr. Prashant Jain.
Thank you very much, sir, for the lovely introduction, and thank you very much, all of you, for inviting me here at this very august gathering. He mentioned I am a veteran of the industry, but I am not a veteran of speaking to audiences like this. And I think I should have spoken before Bala, because it would have been easier for me. Thankfully, Mr. Narayanan has asked me to speak to you about the economy and the markets. So let me start off with that, and that is a ground which I am more familiar with. So I think India is on a very strong wicket. For last 30 to 40 years, this economy has grown every single year. Despite September 11th, despite Lehman crisis, despite Asian crisis, despite left Congress, BJP, irrespective of which governments have come, what has happened inside the country, outside the country, this economy has kept on growing. And that is because our population grows. That is because joint families are breaking up. The number of families is growing faster than the population itself. Affordability in India is rising every year. Our income levels are growing faster than inflation. And even today, after all this growth, only 8% of families in India have a car. So I think going forward, the headroom for economic growth that is available to India is indeed very large to my mind. And now, fortunately, in my opinion, we have one of the best governments in a long, long time. A government that is very focused on removing the bottlenecks to growth. So I think this government is trying to revive the capital expenditure cycle. There is extreme focus on building roads, railways, power transmission distribution, local manufacturing, etc. These steps, what they are trying to take, are very structural. They will lead to a lot of strength to the economy, but it is not about giving someone money so that consumption demand can increase tomorrow. It is about taking longer term steps to revive the capital expenditure, and that takes time. I think before the end of the current year, we should start seeing faster growth in the economy, and in my opinion, in the next 4 to 5 years, India will do extremely well, and this economy is all set to emerge as the world's 5th largest economy before the end of this decade, by 2020. So we should be the world's 5th largest economy after US, China, Germany, and Japan. And we are already the fastest growing economy. The trouble with India has been that this economy has been doing extremely well, and therefore Indians are actually sitting on a gold mine, which is Indian equities. But because despite being a literate country, financially we are less literate, I think we have confused the gold mine for gold itself. So if you look at last 23 years, FI ownership of Indian stock markets has gone from 0 to 23% of the markets. So in 1991, FIs used to own nil in India. Today they own 23% of stock markets. They have brought $150 billion in this period to buy 23% of Indian stock markets. And if you look at the same period, Indians have bought gold, imported gold worth $250 billion. So which is more than the dollars we have earned by selling our stocks. Gold has returned 8-9% CAGR returns over long periods. Equities have delivered 15%. There are many mutual fund schemes which have delivered more than that. So I don't think this is a very smart thing to do. So India may produce the best software engineers, the best lawyers, the best doctors, the best architects. But I think in terms of financial literacy, we are quite illiterate. And when I meet, it is amazing, but it is true, the senior most bureaucrats, the senior most professionals, when you ask them what are they doing with their money, in most of the cases it is either lying in bank, savings bank account, or gold or real estate. So I think the contribution of people like you has been immense in improving the financial literacy, but I think we have a very, very long way to go. If you look at the household assets in India, only 2 to 3% of household assets are in equities. Globally, this number is between 20 to 60%. The whole world wants to invest in India, but Indians themselves are not aware about the potential of equities. So I think it is a very noble profession for you, for us, and without you, I don't think we can make India financially literate. Because unlike Singapore, where there are financial literacy courses which are mandatory, part of the graduation course, in India there are no such courses. And it is on to people like you that you have to take the message of how to invest sensibly, and which will be a win-win-win-win for everyone. The client wins, you win, we win, and even the country wins when we can reduce our gold imports and invest more and more productive assets. And that is why I am extremely grateful to you, extremely obliged for having given me this opportunity to speak to you, because your profession is a very noble profession. Of all the professions that we engage with, whether it's a doctor or a lawyer or an architect or anyone, they ask us for money, they ask us for income, so they earn off their clients. I think yours is the only profession which helps first the customer to increase his income, and then we take a small part of that increased income as our commission. So I think it is extremely noble, very serious, very respectable profession. I think another difference between your work and most other professions is that most other professions are very transactional. So you go to a doctor when you are ill, you go to a lawyer when there is a dispute, you go to an architect when you want to build a new house. But in your case, it's a lifelong relationship. And I have seen cases where the relationship goes beyond generations. So I don't think you are transaction oriented. And that is what distinguishes you from other formats of distribution also. Because there are many channels of distribution available to the customer. In my opinion, your channel, the IFA channel, is closest to the need of the customers. Because you have no targets, you have no boss, you are your own bosses. And therefore you don't have quarterly targets, you don't have pressures. You can work in the client's best long-term interest. And that is why, again, we are very respectful of this. I think we at HDFC share very common, very similar values what you profess. So we also keep the client's long-term interest at the top. We are focused on very simple products. Investing is a very simple thing. I don't think it is complex at all. And it has been our endeavor all along to simplify this industry. So that's why I think we have tried to keep our products extremely simple. So we, like you, try to focus on asset allocation. We focus on the long term, and we focus on building relationships. I think the entire industry growth, when I started my career in 1991, our fund size was 70 crores. And one of the funds was 10 crores or 20 crores. Today it has become India's largest fund. And I don't think it would have been possible without the support of people like you. So I think we are deeply grateful to you for all this growth. Having said this, I also feel that going forward, the growth will be even bigger. Because look at it this way, every 4 to 5 years, there are 4 or 5 levers of growth which are available to people like you and to the industry. One, our economy is growing. It is already the world's fastest growing economy. So the nominal GDP of the country, which represents the total universe of income in the country, is growing at 15% per annum. The second is, as our income levels are rising, the household savings rate in the country is rising even faster. So if you go back to 60s, the India's savings rate used to be less than 20%. Today it is more than 30%. So what that means is that our savings rate are rising faster than the income, and that is the second lever of growth. The third lever of growth, as Bala put it very eloquently, is that mutual funds are an absolutely tiny part of the household financial savings, and it is one of the lowest in the world. As you continue to educate your client, as the next generation becomes richer, as they move into middle class, I think this industry's growth will explode, and it will continue to grow extremely fast. I think this industry is very rewarding even financially for you. Then the way I look at an IFA's career is like this, and this is what I had presented at the Cafe Mutuals conference also, that you can grow your business three ways. One is, if I give you 100 rupees, if I become your customer, every 10 years this money is becoming roughly 4 times, because that is what is the Sensex returns over long periods. And you get a share of that income. That is lever number one for growth. Second is, I am saving, I continue to save every month. In India, even the poor people, even the retired people, they are saving. So I can continue to increase my pool of savings with you every month. And that's the second lever of growth. And the third lever of growth is that if I am happy with you, if I am happy with your service, then I will definitely recommend few clients to you every year. So I think if we give the clients long-term interest, if we explain the power of asset allocation, if we increase the power of equities to him, and if clients have a good experience of the industry, of the asset class, of you, then I have no reason why your business will not continue to compound at very high growth rates over the times to come. Yes, technology can be a threat. I am not an expert on that, but I don't think any technology in the world has managed to replace relationships and trust. And I think that is where your edge comes in. So with this, I would, I still have some time, and maybe I could explain to you one or two more. I think there are two areas where my colleague Kiran Kaushik asked me to highlight, and which is where probably there is room for improvement. And data suggests that the share of the IFA community is lower in the retail fixed income assets compared to other channels of distribution. I think we should not compare. I think probably one reason is because debt is less remunerative. I don't think we should look at it this way. We should not compare debt with equities. Mutual funds are hardly 3-5% of household savings. So there is gold to compete against, there is real estate to compete against, there is banks to compete against. So I think if we make an attempt, there is room for people like you to increase your share of the fixed income retail portfolio. Interest rates in India are likely to move lower. If you recall 2 years back, inflation was around 10%. Today it is down to 4%. But yields on 10-year securities have moved down by only 1.5%, from 9% to 7.5%. So I think as interest rates move lower, mutual funds, fixed income, duration products are a good alternative to recommend to your clients. And that is what I can recommend to you, that you can focus a little bit more on fixed income as well, apart from, of course, the tremendous potential for growth on equities. And the second point, what Kiran asked me to highlight, was the share of IFAs has fallen slightly in the SIP, the SIP business. SIPs, as we all know, are the best forms for young people to save, and India is full of young people. And I don't think this is a great development. In fact, the IFA share in SIP should be higher, and I think there is a lot of room, and you need to work together to reverse this trend. And I assure you about industry and HDFC Mutual Fund's full support to you in any endeavor that you want to take in this regard. With that, I would like to thank you once again for giving me this opportunity to come here and speak to you. I genuinely respect this, and thank you very much.
Thank you, sir, for your wonderful words for the IFA community. I'm sure we will work to growing our SIP book as you wished. And may I request S.R. Chandrasekhar of IFA Galaxy to please give the memento and gift to Mr. Prashant Jain.